The implications of what you're saying is that the market is getting less liquid. I mean, significantly so. And there is another aspect I've noticed on COMEX, and that is that the mining, the mines, they're not hedging it. They're not hedging forward production as much as they have done in the past. And this, of course, throws the onus on the swaps, who are the other side of it. And, unless they've actually got physical sort of tucked away somewhere, they can't actually cut their short positions down at all. I mean, it's just stubbornly refusing to go lower. So it's a tricky thing. And I think what we're seeing, to develop what you were saying about, which sort of implies that liquidity is drying up in the futures markets. What we're beginning to see, I think, is a bear squeeze on the system. And that has got interesting implications. I think, the root of all this, basically, is that this gold is just still disappearing from here and going into firm Asian hands. I think that, the whole of the BRICS thing and all the rest of it, that's going to die down because I think I'm right in saying that Brazil is the new chairman. But so what will happen is that you won't get much on the headlines. I mean, I understand that Lula has got he's having surgery on his brain because he had a hemorrhage from before. I can't see the Brazilians doing an awful lot. But I'm sure that the Russians and the Chinese in the background will continue the good work, I put that in inverted commas, which they did particularly under the Russian presidency, which is, has got another 2 weeks to run. That side of it, I think, is going to quieten down. But this doesn't mean to say that selling of the dollar in return for gold is going to die down as well. I mean, I think that can easily accelerate. I mean, the thing that's fascinating is if you look at the psychology in the market, there is virtually no bullishness in the West. I mean, apart from obviously the odd punter in the futures market who thinks, he sees a momentum and he buys the momentum. He's clueless, really, on that. Or he's just doing a pairs trade. I mean, he's looking at dollar versus gold and gold versus dollar. He doesn't, he's not interested in taking delivery. He's just got a leverage play against one or the other, and he doesn't actually care which. That is the way a trader works, which is absolutely fine. But other than that, I don't think there is anyone really, apart from a few oddballs like you and me, who actually understand what's happening to the currencies and therefore what is going to be reflected in the gold price and why you should hold gold. Buy gold, and stack it. I mean, we know this because the gold is going out into Asia. It's going into the central banks. It's going into the government wealth funds in Asia. I mean, that's quite a lot of where the Chinese stuff is going. You've got the Chinese people, too, who can't actually rush out and buy dollars or whatever to hedge their own currency. Yeah. And, interest rates are tending to drift lower in China as a matter of policy. So, everywhere there's gold accounts, and you've got gold accounts in Russia as well. You can open a gold account at the bank. But the thing is that these guys actually cover their positions. They don't run fractional reserve as we would call it. They don't run these leverage positions or uncovered obligations. So they cover them, and so there is enormous demand amongst people who are frightened of the West and what they're doing to currencies. But that does not include our populations. They've yet to buy it. This tells me that the sentiment, if you like, in bullion markets is still immensely bearish because, I'm not saying bearish in the sense that people are shorting it. No, of course they're not. But they're just completely disregarding it. They're disregarding the messages that are coming out of the bullion market. They may not understand the messages. I can understand that. But they're not even trying to think, perhaps this is something we better find out about. They're not even at that stage.
The dynamics of the gold and silver markets are undergoing profound shifts, driven by a complex interplay of dwindling liquidity, shifting geopolitics, and evolving consumer sentiment. For investors looking to safeguard their wealth or profit from these changes, the key lies in understanding the underlying trends. One of the most pressing issues is the drying up of liquidity in the futures market for gold and silver. Historically, mining companies hedge their production by selling futures contracts to lock in prices. However, as Alasdair Macleod points out, this practice is becoming less common. Many miners are choosing not to hedge, preferring to ride the price appreciation of precious metals. This shift places a greater burden on swaps, the entities on the other side of these trades. Without sufficient hedging from miners, swaps have limited flexibility to reduce their short positions, leaving them exposed. This imbalance is contributing to a broader liquidity crunch in the futures market. The implications are profound. As liquidity diminishes, price volatility increases. We are witnessing the early stages of a bear squeeze, a situation where short sellers are forced to cover their positions, driving prices higher. This is a critical moment for investors, as it sets the stage for significant price movements in the near future. While the West remains largely indifferent to gold, the East is quietly amassing it at an unprecedented rate. Central banks in countries like China, Russia, and India have been consistent buyers of gold, seeing it as a hedge against the vulnerabilities of the global fiat currency system. The cultural affinity for gold in Asian markets cannot be overstated. In China, for instance, gold serves not just as an investment, but as a critical tool for preserving wealth in a system where access to foreign currencies is restricted. Chinese households save roughly 35% of their income, amounting to an estimated $2 trillion annually. A significant portion of this finds its way into gold, bolstering demand even further. Russia is another fascinating case. Despite facing international sanctions and economic challenges, Russia's economy has demonstrated remarkable resilience. On a purchasing power parity basis, it is now the fourth largest economy in the world. Its strategic focus on accumulating gold is a cornerstone of its economic independence, allowing it to sidestep the vulnerabilities of the dollar-dominated financial system. In stark contrast to the East, the West appears oblivious to the unfolding opportunities in the precious metals market. Institutional investors remain fixated on overvalued tech stocks, while retail investors show little interest in gold and silver. The sentiment in Western markets is a paradox. Despite mounting evidence of the dollar's decline in purchasing power, gold and silver are viewed as relics rather than essential portfolio components. This apathy is reflected in the minimal allocation to precious metals in Western portfolios, less than 1% on average. For savvy investors, this disconnect presents an enormous opportunity. As the bubble in overvalued equities bursts, a reallocation of capital into gold, silver, and mining stocks is inevitable. Those who position themselves early will be well placed to benefit from this shift. The question isn't whether gold and silver will rise, it's when and by how much. As liquidity in the futures market dries up and demand from the East continues to surge, the fundamentals are aligning for a significant bull run in precious metals. Institutional capital, once it begins to flow into the sector, will have a transformative impact. Historically, the precious metals market has been a niche space. But as mainstream investors wake up to the vulnerabilities of fiat currencies and the limitations of traditional asset classes, the influx of capital could drive prices to unprecedented levels. The precious metals market is at a pivotal juncture. For those who understand the dynamics at play, the opportunity is clear. Accumulate physical gold and silver, diversify into mining stocks, and prepare for a market environment where precious metals take center stage.
And the average ownership of gold or gold substitutes, whether it's mines or ETFs or whatever, is still a tiny part of everyone's portfolio. And of course, this is another thing. Once you get the switch out of the Nvidias of this world, which will happen because that's where the bubble is, then where does it go? Well, a lot of it gets destroyed, let's face it, because the markdowns are going to be sudden and severe. But what is left over is going to go into mines and ETFs and to a lesser extent physical gold. So this I think it feels to me, speaking as an old broken stockbroker, it feels to me like this is very, very early in the game. And this game, I mean, I don't know how long it's going to run, but I suspect an awful lot of people are just going to miss it entirely. And they will realize once they learn, they discover that actually what's happening is their currencies are going down, not prices going up. As far as the Chinese are concerned, I mean, if they're going to punt, they'd punt on Globex. I mean, I suppose some of the smaller punters may go for some of the mini contracts, and they are wild punters. They really are. That there is no doubt. I think there's the bigger play is something which we should be very much aware of, and that is that Chinese citizens save something like, households save something like 35% of their earnings. Now, 35% of their earnings is roughly $2 trillion. Now, that is going into bank accounts, property. Oh, no, not property anymore. The Shanghai Stock Exchange, well, a little bit maybe, but, that's not so much. But then there's gold. And so, we can see that this demand is continuing and continuing and continuing, particularly since Chinese nationals do not have access to foreign currencies to hedge out of their own currency. So, even if they don't understand the gold story, okay, they've got a predilection for gold, but even if they don't really understand the story, those who want to hedge out of their own currency are forced into gold, or to an extent, I suppose, silver as well, but particularly gold. So I think this is the beginning of the story. And, sort of concerning your question about the outlook really for next year, I think that these currencies, our currencies, have got a very rough time, which will be reflected in a far higher gold price by the end of the year. And that is without geopolitical events. That's another subject which, perhaps we can sort of touch on, because, President Trump reckoned he could get peace in the Ukraine in one day. Dream on. There is absolutely no way. He's appointed some pretty neocon types, if you like, on his, the sort of homeland security, the defense and the intelligence services. I think that, the Russian demands are going to be very, very simple. The bare minimum will be they keep the eastern oblasts and Crimea, and they have cast iron guarantees that the rest of Ukraine will not join NATO and remain completely neutral. Now, I don't know how that later guarantee can be given. I don't know how the establishment in America, the neocons and all the rest of it, would accept that. I think they would probably, this is not going to be resolved in a day. It's going to be resolved on the battlefield, I'm sorry to say.
Yeah.
And here's the interesting thing. We sort of took out sanctions, both financial and, goods and services against Russia. I'd wrote an article on the Russian economy the other day. It was prompted really by, sort of journalists in this country and elsewhere saying that the economy's doomed and all the rest of it. I'm talking about the Russian economy, not our own. The Russians are doomed and all the rest of it. And I looked at this, this is actually completely wrong. And here's some key figures. On a purchasing power parity basis, Russia is now the fourth largest economy in the world.
As we delve deeper into the factors influencing gold and silver, it becomes clear that these metals are not just commodities. They are the cornerstones of a global economic shift. The narrative surrounding precious metals reflects broader economic and geopolitical dynamics, painting a vivid picture of both opportunity and caution for those who understand these changes. Geopolitics is playing an increasingly central role in the narrative around precious metals. The BRICS nations, Brazil, Russia, India, China, and South Africa, are actively working to reduce their dependence on the US dollar. While political leadership changes may momentarily quiet the headlines, the underlying strategy remains unchanged. China and Russia are leading the charge, using gold as a means to de-dollarize their economies. This is no longer speculative. The evidence is in the data. Central banks globally added over 1,100 metric tons of gold in 2023, marking the highest net accumulation in over 50 years. The consistent outflow of gold from Western vaults to Asian hands underscores the shifting balance of economic power. Moreover, geopolitical tensions, whether it's the conflict in Ukraine, trade wars, or regional disputes, are amplifying the need for economic self-reliance. Gold plays a pivotal role in this strategy. It's a store of wealth immune to the weaponization of financial systems, as seen in the sanctions imposed on Russia. These sanctions have ironically accelerated the de-dollarization efforts of the East, with gold acting as the ultimate hedge. For investors, the takeaway is clear. Geopolitical instability is bullish for gold and silver. The more uncertain the world becomes, the stronger the case for owning assets that transcend borders and politics. In the West, retail investors have yet to fully grasp the significance of these developments. Most remain entrenched in traditional asset classes, unaware of the vulnerabilities in the fiat currency system. However, This is likely to change as inflation erodes purchasing power and economic instability becomes more apparent. The cultural affinity for gold in the East offers a blueprint for Western investors. In China, for instance, gold accounts provide an accessible way for individuals to safeguard their wealth. These accounts are fully backed by physical gold, unlike the fractional reserve practices prevalent in Western financial institutions. In contrast, Western markets continue to treat gold as a speculative asset rather than a financial cornerstone. ETFs, while popular, lack the intrinsic safety of physical ownership. The disconnect between Western and Eastern attitudes toward gold presents an opportunity for forward-thinking investors to get ahead of the curve. As inflation continues to rise and fiat currencies weaken, the Western narrative around gold and silver is poised to shift. When it does, the influx of capital into these markets could be transformative. The decline of fiat currencies is not a speculative theory, it's a mathematical certainty. As Alasdair Macleod eloquently puts it, the problem isn't that prices are rising, it's that currencies are losing value. This distinction is crucial for understanding why gold and silver are indispensable in today's economic landscape. Inflation is often understated in official statistics, masking the true erosion of purchasing power. While central banks claim inflation is under control, the lived experience of consumers tells a different story. The price of essentials like food, fuel, and housing continues to climb, leaving households struggling to make ends meet. Consider this. The U.S. national debt has surpassed $33 trillion, with annual deficits now exceeding $1.5 trillion. These figures are unsustainable. As governments print more money to cover their obligations, the purchasing power of fiat currencies will continue to erode. Gold and silver offer a sanctuary in this environment, preserving wealth as fiat currencies lose their luster. Silver, often referred to as gold on steroids, offers unique advantages. Its dual role as a monetary and industrial metal makes it a compelling investment. The current gold-to-silver ratio of 85:1 is historically high, indicating significant room for silver to outperform. Silver's industrial applications, particularly in renewable energy technologies, add to its appeal. As the global push for sustainability accelerates, demand for silver in solar panels and electric vehicles is set to rise. This creates a perfect storm for investors, combining the stability of a monetary metal with the growth potential of an industrial commodity. Additionally, silver's lower price point compared to gold makes it more accessible to retail investors. This accessibility, coupled with its higher volatility, means that when the next bull market in precious metals arrives, silver is likely to deliver outsized gains. As institutional capital begins to flow into precious metals, mining stocks are poised for significant appreciation. Historically, mining equities have offered leveraged exposure to rising metal prices, often delivering returns that far exceed those of the metals themselves. The mining sector has been underinvested in for years, leading to a dearth of new projects and limited production capacity. This lack of investment has created a supply bottleneck that will become increasingly evident as demand for gold and silver rises. For investors, this presents a dual opportunity: the chance to profit from rising metal prices and the potential for outsized gains in mining stocks. Companies with low production costs, high-grade reserves, and strong management teams are particularly well-positioned to benefit. Physical accumulation. Focus on acquiring gold and silver in their physical forms. Coins and bars provide the most direct exposure, free from the counterparty risks associated with ETFs and other paper assets. Diversify into mining stocks. Look for mining companies with low production costs and strong reserves. These stocks offer leveraged exposure to rising precious metals prices. Stay informed. Understanding the macroeconomic and geopolitical factors driving precious metals is crucial. Stay updated on central bank policies, currency trends, and global economic developments. Adopt a long-term perspective. Precious metals are not a get-rich-quick scheme. They are a hedge against uncertainty and a means to preserve wealth over time. Consider silver ETFs or physical holdings. For those who can't afford significant gold holdings, silver offers an attractive alternative with potentially higher upside. The geopolitical landscape is rife with uncertainty, from ongoing tensions in Ukraine to potential conflicts in the South China Sea. These risks amplify the appeal of gold and silver as safe haven assets. President Trump's assertion that he could broker peace in Ukraine in a day is optimistic at best. The reality is that geopolitical conflicts are deeply entrenched, driven by complex historical, economic, and strategic factors. As these tensions persist, the demand for gold as a hedge against uncertainty will only grow. Moreover, the weaponization of financial systems, such as the freezing of Russian reserves, has underscored the vulnerabilities of the current monetary order. Gold offers a way for nations to circumvent these vulnerabilities, further bolstering its appeal. As we move into 2025, the stage is set for a transformation in how gold and silver are perceived and valued. These metals are not just relics of the past. They are vital tools for navigating the uncertainties of the present and future. For investors willing to challenge conventional wisdom and embrace the opportunities in precious metals, the rewards could be substantial. The shift from fiat currencies to tangible assets is not just a possibility, it's an inevitability. By understanding the dynamics at play, you can position yourself to not only survive, but thrive in the coming economic landscape. Gold and silver are more than investments. They are lifelines in a world of growing complexity and uncertainty. Now is the time to act. With geopolitical tensions, economic instability, and the erosion of fiat currencies, the case for precious metals has never been stronger. For those who see the writing on the wall, the opportunity is clear. Accumulate physical gold and silver, diversify into mining stocks, and prepare for a market environment where precious metals take center stage. The next decade belongs to gold and silver. The question is, will you be part of it?
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.